Fed leaves low rates alone and foresees no moves in 2020. Washington, AP. The Federal Reserve left its benchmark interest rate alone Wednesday and signaled that it expects to keep low rates unchanged through next year. The Fed's decision follows 3 rate cuts earlier this year. It reflects its view that the U.S. economy has so far withstood the U.S. China trade war and a global slump and remains generally healthy. Its benchmark rate, which influences many consumer and business loans, will remain in a low range of 1.5% to 1.75%. In a sign of the Fed's confidence about the economy, its latest policy statement dropped a phrase it had previously used that referred to uncertainties surrounding the economic outlook. That suggests that the Fed is less worried about the impact of the U.S. China trade war or overseas developments. Financial markets moved slightly up soon after the Fed issued its statement. The Fed may prefer to leave rates alone through 2020, an election year. But many analysts note that the economy faces risks from the trade conflicts, a global slowdown and a potentially disruptive Brexit and say the Fed may feel compelled to cut rates at least once next year. Persistently low inflation with very low unemployment has led many Fed officials to conclude that rates can remain lower for much longer than they thought without spurring higher prices. Low rates help consumers and businesses afford to borrow and spend. Still, savers have struggled to find returns outside the stock market that can keep them ahead of inflation. Chairman Jerome Powell has said that this year's Fed rate cuts have helped lower mortgage rates and spurred growth in home purchases. Auto sales have also remained healthy as more Americans have borrowed to buy cars. After having raised its benchmark short-term rate 4 times in 2018, the Fed reversed course this year and cut rates 3 times to a range of 1.5% to 1.75%. Powell has portrayed those cuts as mainly insurance against a slowdown resulting from weak global growth and President Donald Trump's prolonged trade war with China. Monthly job growth reached its highest point this year in November, and the unemployment rate matched a 50-year low of 3.5%. Measures of consumer confidence also remain at historically high levels. Powell and other Fed policymakers have made clear that they are no longer worried that a healthy job market will necessarily fuel excessive inflation. Instead, they would like to see inflation reach their 2% target level after running below it for most of the past 7 years. Even with unemployment at a 50-year low of 3.5%, the Fed's preferred inflation gauge showed prices rising by just 1.3% in October compared with a year earlier. Tame inflation and ultra-low unemployment have led Fed officials to rethink their view of the so-called neutral rate. This is the Po. For more on this story, visit the news article link.